2.5 hours, that is not a surprise attack. That is not a blind strike. That is a window where radar systems were active, satellites were tracking, allies were watching, and yet the target never moved. If the warning was delivered, if the jets were tracked in real time, if Beijing saw everything unfold, then the real question is not how the strike succeeded. The real question is, who decided not to act? And if intelligence at the highest level can disappear inside its own system, what does that mean for alliances, for global stability, for capital, for you? Because when information fails at the top, markets fail next. Welcome to Boring Currency Ledger. If you are above 50 and still believe geopolitics has nothing to do with your savings, gently press the subscribe button. Consider it a small long-term insurance policy for your financial awareness. Before this briefing continues, tell us in the comments, which country are you watching from? Because what happened in those 2.5 hours may already be affecting your economy. 2.5 hours. In military terms, that is not a sudden strike. It is not a surprise measured in seconds. It is a measurable window of time, long enough to make calls, long enough to move a convoy, long enough to relocate a meeting, long enough to act. According to diplomatic statements and defense briefings, Chinese radar systems detected Israeli aircraft shortly after takeoff. Satellite feeds tracked their route. Speed, altitude, and direction were reportedly transmitted in real time. The aircraft were observed crossing Iraqi airspace. The estimated flight time from Tel Aviv to Tehran was approximately 2.5 hours. Yet when the strike occurred, the supreme leader remained in his compound. Around 40 senior commanders were reportedly present. The meeting was not dispersed. The location was not abandoned. This is the operational puzzle. If the warning existed, why was it not used? For business leaders, this question is familiar. Many companies fail not because they lack information, but because they fail to act on the information they already have. Market data may warn of slowing demand. Internal audits may signal structural weakness. Risk reports may highlight exposure. But action requires alignment. In state systems, the chain of action is even more complex. Intelligence must move from detection to verification, from verification to authorization, from authorization to execution. At each stage, a human decision is required. A delay at any point changes the outcome. The technology may function perfectly. The radar may detect accurately. The satellite feed may be precise. But if the decision chain hesitates or is compromised, the result remains the same. The central issue, therefore, may not be technological failure. It may be institutional vulnerability. In highly centralized systems, authority is concentrated. That concentration creates efficiency in stable periods. It also creates fragility during crisis. If relocation of leadership requires layered approval, valuable minutes disappear. If commanders question the authenticity of intelligence, delay increases. If internal distrust exists, warnings may not move upward with urgency. There's another possibility that intelligence communities understand well: penetration. Throughout modern history, successful decapitation strikes have relied less on superior hardware and more on insider access. An insider does not need to control the entire system. They only need to influence one critical moment: a meeting confirmation, a location detail, a delayed transmission. 2.5 hours is a long time for radar to function. It is also a long time for hesitation to operate. China and Russia reportedly invested months strengthening Iran's defensive structure: advanced radar, signal protection, missile defense coordination. These systems were built to reduce surprise, but no defensive grid can override a human bottleneck. For entrepreneurs and investors, this distinction is important. The modern economy runs on information advantage. Companies invest heavily in analytics, forecasting tools, artificial intelligence, and real-time dashboards. Yet, strategic collapse often happens when leadership ignores early signals. The global financial crisis offered warnings for years before collapse. Debt levels were visible. Risk exposure was documented. Complexity was known. But warnings did not convert into structural change. In this case, the warning window was measured not in years, but in hours. If intelligence reached mid-level command but did not alter behavior at the top, the breakdown becomes systemic. It suggests disbelief, paralysis, or internal compromise. Each possibility carries global implications. If disbelief caused inaction, it signals overconfidence. If paralysis caused inaction, it signals rigidity. If compromise caused inaction, it signals deep penetration. For markets, the difference matters. Energy traders examine stability through predictability. Shipping firms examine route security. Insurance markets calculate probability. All depend on the assumption that major systems act rationally on available information. When a system receives clear warning and still absorbs a decapitation strike, predictability weakens. Predictability is the foundation of capital allocation. Investors price assets based on risk expectations. When institutional reliability declines, risk premiums rise. Borrowing costs increase. Insurance spreads widen. Commodity volatility intensifies. The 2.5-hour window therefore represents more than a military timeline. It represents a structural stress test. Radar worked, satellites tracked, data moved, but action did not follow. And for serious observers of geopolitical risk, the question is no longer whether technology failed. The question is whether the human architecture behind the technology is more fragile than the world assumed. Silent powers, open vulnerabilities. By the morning after the strike, global markets had already reacted. Brent crude moved sharply upward in early trading. Insurance premiums for vessels crossing the Strait of Hormuz widened. Gulf equity indices opened lower before partial recovery. Defense stocks in major Western markets showed gains. Safe haven assets strengthened as capital quietly rotated toward protection. But in Beijing and Moscow, the reaction was not visible on a trading screen. It was happening inside closed-door review sessions. China had invested heavily in its strategic relationship with Iran over the past decade. Energy agreements worth hundreds of billions of dollars had been discussed under long-term cooperation frameworks. Iran supplies a significant portion of China's discounted crude imports, often estimated near 10% of total Chinese oil intake in recent years. For Beijing, Iran is not just a political partner. It is an energy node inside the Belt and Road Network. Russia's position is different but equally strategic. Moscow and Tehran deepen military and technological cooperation under sanctions pressure. Drone technology transfers, missile defense discussions, and financial coordination outside Western systems created a parallel channel of resilience for both states. Yet despite radar systems, satellite data, and months of reported defensive upgrades, the strike succeeded in eliminating the highest level of Iranian leadership in a single coordinated operation. For Beijing and Moscow, this is not simply Iran's failure. It is a stress test of their exported security architecture. If an ally that received advanced detection systems still lost its command structure in one decisive moment, questions multiply quickly. Was the defensive grid incomplete? Was the response protocol too centralized? Or was the internal chain compromised? Strategic partnerships are built on two currencies, capability and credibility. Capability refers to hardware, radar, missiles, intelligence feeds. Credibility refers to trust, confidence that shared systems will function under pressure. If capability fails, upgrades can be purchased. If credibility fails, alliances weaken. For China, the reputational cost matters globally. Beijing positions itself as a reliable long-term partner, particularly to countries seeking alternatives to Western security frameworks. If a flagship partner experiences a visible collapse despite Chinese technological backing, competing powers will highlight that weakness. For Russia, already engaged in prolonged conflict elsewhere, the optics are equally sensitive. Moscow has emphasized resilience under sanctions and the strength of non-Western alignment networks. A high-profile decapitation strike against a strategic partner forces internal reassessment. This is where the economic dimension becomes critical. Iran sits near the Strait of Hormuz, a waterway through which roughly 20% of global oil supply transits daily. On average, more than 17 million barrels of crude move through that corridor each day. Even temporary disruption sends pricing signals across global markets. Following the strike, shipping companies began reassessing risk exposure. War risk insurance premiums, which had previously risen during regional tensions, widened further. Freight costs reflect probability, not certainty. Even rumors influence cost structures. Energy importers in Asia monitor these movements closely. China, Japan, South Korea, and India depend heavily on Gulf energy flows. Any sustained instability raises input costs for manufacturing economies. This is where business leaders should focus. Geopolitical shocks rarely remain confined to borders. They transmit through commodity prices, shipping routes, currency markets, and capital flows. If Beijing and Moscow enter a period of internal intelligence review, information sharing speed may temporarily slow. Slower coordination can reduce deterrence clarity. Reduced deterrence clarity increases regional unpredictability. Unpredictability increases volatility. Volatility increases hedging costs. Hedging costs reduce margins. For multinational corporations operating across Asia and the Middle East, this chain reaction matters more than political speeches. There is also a second layer of strategic consequence. When a major power invests in building an ally's defensive infrastructure and that infrastructure fails publicly, internal scrutiny intensifies. Procurement processes are reviewed. Communication channels are audited. Personnel loyalty is examined. Such internal tightening can create short-term rigidity. In business terms, it resembles a corporation that responds to a breach by freezing decision-making while conducting internal investigations. During that freeze, competitors move faster. If China and Russia temporarily reduce outward operational engagement while reviewing intelligence vulnerabilities, regional actors may adjust behavior independently. Gulf states may strengthen bilateral arrangements elsewhere. European powers may recalibrate energy diplomacy. The United States may test new pressure points. In global markets, perception often moves ahead of policy. Investors begin to price scenarios before official announcements are made. Oil volatility, defense sector momentum, safe haven demand, and emerging market currency fluctuations are not random reactions. They are early-stage adjustments to institutional uncertainty. The core issue is not whether China or Russia will respond militarily. Current assessments from multiple geopolitical analysts suggest neither power seeks direct escalation. The cost of direct confrontation would be enormous. The deeper issue is structural confidence. If advanced systems could not prevent leadership elimination despite a measurable warning window, the assumption of defensive reliability changes. When assumptions change, capital reprices. And when capital reprices, the consequences extend far beyond the original battlefield. For entrepreneurs and investors watching from outside the region, the lesson is direct. Strategic alliances are assets, but they are also liabilities when stress-tested publicly. Silent review sessions in Beijing and Moscow may not make headlines, but their conclusions could shape energy flows, military procurement cycles, and risk premiums for years, and markets are already adjusting. Death ground economics. When escalation becomes rational. In classical military theory, death ground describes a position where retreat is impossible. When a force believes survival itself is at stake, normal cost calculations change. Risk tolerance expands. Restraint weakens. Escalation becomes rational. After the decapitation strike, Iran entered that psychological zone. 40 days of national mourning were announced. A rapid leadership transition was executed. Retaliatory strikes were launched against multiple regional targets. Maritime security alerts intensified. Military rhetoric hardened. For global markets, the concern is not emotion. It is escalation math. The Strait of Hormuz remains one of the most critical choke points in the global economy. Roughly 17 to 20 million barrels of oil per day pass through it. That represents about 1/5 of global petroleum consumption. In addition, nearly 1/3 of the world's liquefied natural gas, LNG, shipments transit nearby Gulf routes. Even minor disruption affects pricing immediately. Within hours of heightened tensions, Brent crude futures showed sharp upward movement in early trading sessions. Energy traders began widening volatility assumptions. Tanker tracking firms reported congestion signals. Insurance underwriters increased war risk premiums for vessels operating in Gulf waters. Shipping insurance is not theoretical. It directly affects delivered commodity cost. When war risk premiums rise from fractions of a percent to several percentage points of cargo value, importers pay more, refiners pay more, consumers eventually pay more. For Asian manufacturing economies, the impact compounds. China imports more than 11 million barrels of crude per day. Japan and South Korea rely heavily on Middle Eastern supply. India sources a significant share of its crude from Gulf exporters. A sustained disruption, even partial, adds inflationary pressure to already fragile global supply chains. Death ground logic does not require total closure of a waterway. It requires credible threat. If a state under existential pressure signals willingness to mine shipping lanes, target tankers, or strike energy infrastructure, markets price that risk long before physical damage becomes widespread. Insurance spreads widen first, freight costs rise second, energy futures spike third, inflation expectations adjust fourth. Business leaders must understand this sequence. Inflation does not begin at the supermarket. It begins at maritime choke points. In recent years, global supply chains have already absorbed shocks. Pandemic shutdowns, container shortages, semiconductor bottlenecks, regional conflicts. Each event exposed structural fragility. The lesson was clear. Just-in-time systems are vulnerable to geopolitical disruption. Now consider a region that handles nearly 30% of global seaborne oil trade operating under death ground conditions. Energy infrastructure in the Gulf is highly concentrated. Major export terminals, refineries, and storage hubs sit within missile range of regional actors. Saudi Arabia's Abqaiq processing facility, attacked in 2019, temporarily removed 5% of global oil supply in a single event. Markets remember that shock. If escalation continues, even limited strikes on ports or energy terminals could remove millions of barrels per day from supply. Replacement capacity is limited. Strategic petroleum reserves exist, but they are finite and politically sensitive to deploy. For entrepreneurs, the danger lies in misreading volatility as opportunity. Rapid oil price spikes often attract speculative capital. Traders attempt to ride momentum. Commodity-linked equities surge temporarily. But death ground volatility is nonlinear. It does not move in smooth cycles. It moves in sudden jumps. Nonlinear volatility damages planning cycles. Airlines hedge fuel months in advance. Shipping firms contract freight rates ahead of delivery. Manufacturers lock in raw material costs. When energy pricing becomes unstable, forecasting models lose reliability. Loss of reliability increases defensive behavior. Corporations delay capital expenditure. Banks tighten credit exposure to high-risk regions. Sovereign wealth funds rebalance towards safer jurisdictions. Emerging market currencies weaken under imported inflation pressure. There is also a geopolitical multiplier. If regional escalation disrupts oil flows, major powers must choose between intervention and containment. Military deployment raises further risk. Diplomatic negotiation under pressure signals weakness. Both paths introduce uncertainty. Markets dislike uncertainty more than they dislike bad news. A clearly negative outcome can be priced. An unpredictable trajectory cannot. Death-ground conditions remove predictability. The state under pressure may accept economic damage if it believes survival requires confrontation. That changes the calculus for energy-dependent economies worldwide. Central banks already face difficult decisions. Inflation has moderated in some regions, but remains sensitive to commodity shocks. A sustained energy spike could force monetary tightening at a time when growth is slowing. Higher rates increase borrowing costs. Higher borrowing costs reduce business expansion. Reduced expansion slows employment growth. Thus, a military decapitation strike transforms into macroeconomic tightening risk within weeks. For young entrepreneurs watching global headlines, the temptation is to treat geopolitical conflict as distant drama. But the capital cycle is global. Fuel prices affect logistics. Logistics affect retail pricing. Retail pricing affects consumer demand. And consumer demand determines revenue. When a nation operates on death ground, escalation becomes a rational strategy. That rational escalation feeds directly into commodity markets. Commodity markets feed into inflation. Inflation feeds into monetary policy. The chain is clear. The real risk is not a single missile strike. The real risk is a prolonged period where one side believes it has nothing left to lose. Because in global economics, the most dangerous environment is not high growth or even recession. It is unpredictability under pressure, and that is precisely what death ground produces. Bomb first, negotiate later. The credibility premium. 36 hours after the strike, a second signal entered the system. The President of the United States stated that talks were possible. He indicated willingness to negotiate with the same government that had just been targeted. Timing was described as uncertain. Conditions were not clearly defined. For financial markets, this was not diplomacy. It was sequencing. In strategic policy, sequence matters as much as substance. When kinetic action is followed immediately by negotiation language, observers reassess the clarity of intent. Was the strike designed to trigger regime change? Was it meant as deterrence? Was it leverage for negotiation? If the objective shifts publicly within days, credibility becomes variable. And credibility carries a measurable economic premium. Global capital markets operate on assumptions about superpower consistency. The United States anchors the world's reserve currency system. U.S. Treasury securities remain the deepest sovereign bond market, with over $26 trillion outstanding. The dollar is involved in roughly 88% of global foreign exchange transactions. When U.S. strategic signaling appears stable, capital flows smoothly. When signaling appears inconsistent, risk premiums adjust. Following the strike and subsequent negotiation signals, volatility indexes reflected renewed uncertainty. The U.S. dollar strengthened temporarily against some emerging market currencies as investors sought safety. Gold prices edged upward, reflecting hedging behavior. Defense sector equities outperformed broader indices in early sessions. These movements are not emotional reactions. They are pricing mechanisms. If policymakers demonstrate unpredictability, global borrowers pay more. Consider emerging markets that depend on dollar-denominated debt. Many developing economies finance infrastructure and trade through U.S. currency borrowing. When a geopolitical tension rises, investors demand higher yields to compensate for uncertainty. Higher yields increase refinancing pressure. A 1 percentage point rise in borrowing costs can translate into billions in additional annual interest payments for heavily indebted states. This is how military sequencing influences sovereign balance sheets. There is also an alliance dimension. Several Gulf states host U.S. military assets and depend on American security guarantees. At the same time, they are deeply integrated into global trade networks and energy markets. Publicly, many governments condemned regional escalation while avoiding direct criticism of major powers. This neutrality is strategic. But behind diplomatic language, economic planners recalculate exposure. If regional infrastructure becomes a target in proxy retaliation, insurance premiums rise, capital projects slow, and foreign direct investment pauses. The Gulf Cooperation Council economies collectively manage sovereign wealth funds exceeding $3 trillion. These funds allocate globally across equities, real estate, technology, and infrastructure. When regional security assumptions weaken, portfolio strategy shifts, less regional risk, more external diversification, greater liquidity buffers. Meanwhile, energy markets respond to each diplomatic signal. If negotiations appear credible, oil prices stabilize. If rhetoric hardens, futures spike. This creates a credibility premium embedded in every barrel traded. The bomb first, negotiate later sequence introduces ambiguity into deterrence theory. Traditional deterrence relies on clear red lines. If action is taken, consequences follow predictably. But when action is followed quickly by dialogue, observers struggle to interpret strategic commitment. Ambiguity increases optionality for policymakers, but it decreases clarity for investors. Clarity reduces volatility. Ambiguity increases it. For entrepreneurs, this distinction matters more than headlines. Unstable geopolitical sequencing effects, currency conversion costs. For international trade, commodity input pricing, venture capital risk tolerance, cross-border investment appetite. If capital perceives that major powers are improvising rather than executing a long-term framework, financing tightens. Banks reassess exposure to politically sensitive regions. Private equity firms demand higher internal rates of return. Insurance firms expand exclusion clauses in contracts. These micro-adjustments accumulate. There's also a domestic fiscal dimension. The United States already carries federal debt exceeding $34 trillion. Elevated geopolitical tension often implies higher defense spending. Increased spending financed through borrowing adds supply to treasury markets. Greater supply requires stable demand to prevent yield spikes. If foreign buyers hesitate due to geopolitical uncertainty, yields rise. Higher yields increase domestic borrowing costs, from mortgages to corporate bonds. Thus, credibility in foreign policy feeds directly into domestic financial conditions. Negotiation is not weakness. Dialogue is standard diplomatic practice. But when it follows immediately after maximum force action, it reshapes perception. Markets trade perception. The question investors now examine is not simply whether talks will occur. It is whether strategic objectives are consistent. If objectives are clear, volatility subsides. If objectives evolve unpredictably, volatility persists, and volatility carries cost. For business leaders and young entrepreneurs, the takeaway is sober. Geopolitical sequencing is not distant theater. It is a variable in capital pricing models. When the world's largest military power demonstrates strategic ambiguity, the cost of capital adjusts globally. The strike lasted minutes. The negotiation signal lasted seconds. But the credibility premium introduced by that sequence could influence markets for years.